The car market crisis is far more complex than people realize. With car prices crashing down, some would assume that the cost of auto payments would go down too. But the exact opposite is happening right now. Buyers are seeing the value of their vehicles plummeting while they're stuck with some of the most expensive auto payments ever seen. And that's occurring at a time when jobs are at risk and inflation is pushing the cost of daily necessities to record highs. Millions of workers are falling behind their loan obligations, getting in danger of losing their vehicles while still carrying massive amounts of car debt. This is especially true for young Americans. Right now, Generation Z and Millennials are being economically destroyed by the auto loan crisis as they can't afford their car payments and are about to face dire consequences that can impact their financial future for decades. We have never had a messier outlook for the auto sector than we have now in 2023. The ripple effects will be quite disastrous, and it looks like a major collapse is already underway. That's what we're going to expose today. But before moving on, we kindly ask you to support our channel with a thumbs up and don't forget to subscribe. Automobiles were one of the commodities that have experienced some of the most dramatic cost spikes over the past 12 months. But a perfect storm of ballooning car prices and soaring auto loan interest rates have created an affordability crisis that is putting immense pressure on both the auto industry and individual consumers. The average new car now stickers at $50,000, an increase from the record $47,000 reached in December, according to Kelley Blue Book and its parent company, Cox Automotive. The price of used cars and outdated car models, on the other hand, is falling by the double digits, and the latest drops have been a huge blow for millions of American motorists. Over the past 3 years, they have taken significantly more debt to buy vehicles. This is a trend that's been particularly predominant for Generation Z and Millennials, who the Federal Reserve believes may have borrowed way beyond their means. New data shows that young Americans' finances have started buckling under the weight of expensive car loans, one more worry to contend with in this precarious economic environment. Although it's somewhat normal that this group actually has higher car debt rates because many of them are buying their first car, data compiled by visualcapitalist.com shows that for Americans under the age of 40, vehicle-related debt has grown by 31% since the pandemic, almost 3 times faster than for other age groups. Supply chain issues and inflationary pressures have undeniably contributed to this alarming situation. Used car prices shot up by almost 70% in 2 years and still remain 47% higher than they were in 2019. At the same time, because of the elevated prices and higher interest rates, the Fed reports that the average auto loan is now $24,000, up 41% from 2019's value of $17,000. Over that same span, supply and demand imbalances made almost half of all cars be sold above the manufacturer's suggested retail price. No wonder why right now Millennials and Generation Zs say that car payments account for over 20% of their after-tax income, according to Cox Automotive. In partnership with Moody's Analytics, Cox revealed in the new report that vehicle affordability dropped to the worst level on record last month, also highlighting that the number of median weeks of income needed to purchase the average new vehicle now stands at 40.6 weeks, nearly 1 year's worth of pay, from a downwardly revised 40.2 weeks in January. New vehicle affordability continues to be much worse now than it was a year ago when incentives were higher, Cox said in the news release. And of course, the amount of auto debt transitioning into serious delinquency is much higher for Generation Z and Millennials, who carry elevated levels of credit card and student loan debt and have less stable jobs. With student loans expected to resume this summer and the highest interest rates in decades weighing on credit card balances, these struggling borrowers are being hit by many different fronts. Many factors are eating into their ability to make car payments on time. Last year alone, these generations saw $20 billion in auto debt fall 90-plus days behind. And even though the defaults on car loans are a sign amid the larger trend of an across-the-board rising cost of living, with no generation immune from that phenomenon, younger consumers feel the pinch the most, since they have fewer accumulated assets to act as a buffer. In fact, a new survey of Generation Z and Millenials by the consulting group Deloitte exposed that the rising costs for essentials, including cars, housing, and healthcare, are at the top of the overall concerns for both groups, especially now that companies are starting to conduct mass layoffs again. Financial anxiety is widespread among Generation Zs and Millennials, Deloitte noted. They are worried about their day-to-day finances and fear they won't be able to afford their needs. Deloitte also found nearly half of both generations are currently living paycheck to paycheck and worry that they won't be able to cover their expenses over the next 60 days, with 30% of both groups expressing general financial insecurity. The consulting firm also found 1/3 of millennials and 43% of Generation Zers have taken on side jobs in addition to their primary employment in an effort to pay their bills and to meet their loan obligations. With auto loan delinquency rates still spiraling amongst this group, the consequences for young Americans can be more devastating than they realize. On a personal level, the financial distress caused by unaffordable payments and the delinquent status can impact their access to credit for years to come. These payments are like second mortgages for these people. I expect a lot of wrecked credit scores in the next few years, says Henry Hernig, data journalist for Jerry. Young Americans will have their credit score negatively affected by late repayments on car loans, which may then impact their ability to find housing and request other types of borrowing in the future. A loan default adds a negative mark to people's credit reports, and until the entire debt is paid, their ability to start building wealth will remain compromised. On top of that, their vehicle remains at risk of being repossessed, and that's already happening at alarming numbers. Once your loan defaults, the lender is legally allowed to repossess the car you just bought. In some cases, people are notified by their lender beforehand with a final opportunity to cover the missed payments before repossession, but oftentimes people are unable to cover the missed loan amount, so lenders can take back their vehicle and sell it, while borrowers still owe money after the repossession. In case your lender is able to sell your vehicle at a fair market price, you likely won't have to cover the remainder of your loan amount. But if the lender sells your repossessed vehicle for less than your loan default balance, this means delinquent young Americans will still have to pay the difference. This is called a deficiency balance, which ensures the lender doesn't lose money from your missed loan payments. They're also responsible for any costs associated with repossessing their vehicle. Ivan Drury, automotive journalist at Edmunds.com, explains. The same logic applies to a scenario where this group owes more on their auto loan than their vehicles are worth, known as being upside down, meaning that they have negative equity. For instance, if you have $15,000 left to pay on your auto loan and your car is now worth $10,000, that means you have negative equity of $5,000 that you still have to pay. Edmunds data shows that the average amount owed by millennials and Generation Zers on their upside-down loans in Q4 2022 was $5,341 compared to $4,141 in Q4 2021. As we shifted toward an environment with diminished used car values, and rising interest rates over the past few months, consumers have become less insulated from those riskier loan decisions, Drury added. We're only seeing the tip of the negative equity iceberg. To make things even worse, their remaining auto loan debt can be sent to a third-party collection agency. So, if they don't cover the deficiency balance in an appropriate time frame, the agency will likely sue them for repayment, only adding to their financial woes. In 2022, the average U.S. credit score required to purchase a new car was 726. But Generation Z has an average credit score of 660.5, while the average score for millennials falls at 667.4. Stacked with elevated interest rates from having lower credit scores on average, it's understandable why the likelihood of loan default for Generation Z and millennials is disproportionately higher. Another challenge that likely contributes to such higher default rates is the increasing amount of time it takes to pay off an auto loan. In 2021, 27.21% of auto loan borrowers were taking 73 to 84 months to pay off their loans, an almost 7% rise from the previous year. With a longer loan term, borrowers will likely pay a higher interest rate and ultimately end up paying more over time. In an interview with CNBC, Jerry Hernick points to the Fed's aggressive credit tightening policy as the main culprit in the large jump in delinquency in recent months. It's had such a wide-ranging impact, driving up loan costs across the board, and as a result, pushing up credit card debt and auto loan debt, stressed Hernick. Moreover, budgets are being stretched much thinner as everything is much more expensive. Rent is higher, groceries are higher, car ownership costs such as insurance and repairs are all much higher. It all adds up, he notes. But the truth is that the upward spiral of auto loan delinquency didn't just happen by chance or because cash-strapped young Americans have weak finances and are increasingly using credit cards. For years, predatory lenders have been offering expensive loans, sometimes more than $700 a month. They're very well aware that the borrower doesn't have the means to pay back on time or at all. In other words, millions of auto loans are set up to fail from the start. The main catalyst of the high auto loan delinquency is the fact that lenders are taking advantage of ill-advised, young, and illiterate consumers. At the end of the day, they have alternatives to cope with the debt, but consumers don't. Their financial future is marked, and the repercussions can push them to the brink. Today, the percentage of young borrowers at least 60 days late on their car payments is higher than it was during the peak of the Great Recession in 2009. It looks like young Americans just can't afford to drive, outlines Matt Moore, Vice President of the Highway Loss Data Institute. Paying for their own cars, gas, and insurance is hard if they can't find a good-paying job, he emphasized. And that's at the root of the auto loan crisis we're now witnessing. Deep problems including disproportionate generational joblessness and underemployment, the growing burden of college loans, greater financial dependence on their parents, and general economic stagnation in the United States have been affecting millennials and Generation Zs profoundly in many different ways. The consequences that they are set to face stemming from their car debt, which should be their first step into a more stable future, can economically eviscerate them and take away other chances and opportunities for financial growth that could be life-changing. That's what a broken system looks like. And these are just the very first chapters of a much larger economic and financial meltdown that will continue to shake our country to the core. Thank you for watching. Please subscribe. Here's to the next time.